It's happening again. Your rates are rising, prices are falling, the headlines are screaming crash. Consumer confidence just hit its lowest reading since 1973. And right now is the best time to build wealth with property in Australia. Not in spite of what's happening, simply because of it. I'm Oliver Chung, founder of Insight 2. I help investors buy and manufacture equity in residential property. And I'm going to tell you exactly why this market right now is the entry point, especially because it doesn't feel that way. In the next 12 minutes, I'm going to walk you through three things. First, why 2026 is singing the same song of 2023. What's actually the same and what the headlines are missing. Second, a real story of two investors who looked at the same market in 2023. One executed a contract, the other one waited, and the 141,000 gap that the decision created. And third, exactly where I deploy 700K to $1 million of capacity in the next 90 days. What to target and what to avoid. By the end, you'll know whether you're sitting on the sidelines or whether you've just been handed on an opportunity cost that most investors had never seen coming. The most underappreciated parallel between 2023 and 2026 isn't the data. It's simply the emotion. Let me take you back mid-2023. Every headline in this country was telling you property was finished. The mortgage prison, the property cliff, the crash is here. Consumer confidence was in the gutter. Auction clearance rates were falling and investors were simply pulling back. Listings were rising and the overwhelming consensus was that you'd be insane to buy property in the environment. Let's have a look what happened in Sydney. Sydney fell 6.3% from peak to trough. Melbourne declined by 5.7%. The mood was absolute disaster. But then what happened? Within 12 months, Sydney was up 14.7% from the trough. Perth went on a run that has now delivered over 77% of growth across 5 years, if not more. Brisbane and Adelaide both posted 70% plus. The investors who bought during peak captured the entire rebound, and the investors who waited for confirmation missed 12 to 24 months of growth and paid 8 to 15% more of the privilege of feeling safe. Now look at May 2026. Cash rate is back at 4.35%, the exact same level as the 2023 peak. Consumer confidence at its lowest reading since the ANZ Roy Morgan series began, lower than the GFC, lower than COVID, lower than 2023. The headlines are screaming crash. Top quartile, Melbourne and Sydney already down 5 months in a row. Investor sentiment on the downhill. The pattern isn't similar. It's structurally identical and it's emotional signature. And here's the part that matters. The underlying fundamentals have not been broken. They've actually tightened. What we're seeing is vacancy rates near record low, around 1.5% nationally. Certain suburbs a lot tighter. Population growth running at 423,000 a year. Dwelling shortfall forecast to hit 380,000 by 2030. And the dwelling production is dropping down by 11% in 2026 because of rising construction costs and labor shortages. But hey, let's face it, housing demand is still outstripping supply by a significant margin. The shortage is simply not getting better. It's getting worse. And yet, the sentiment of a lot of investors is telling people to run. The disconnect between sentiment and fundamentals is where the wealth is built every single time. I'm not going to sit here and tell you that 2026 is identical to 2023. It's simply not. There are three differences and you need to hear them honestly. The rate trajectory. In 2023, the market was pricing in cuts. There was a light at the end of the tunnel. In 2026, the RBA has hiked 3 times this year. CBA thinks rates will hold. Westpac will think 2 more hikes. There's no consensus on when that relief is arriving. That means a sentiment trough could last a little bit longer this time before that recovery takes hold. Let's face it. Number 2, geopolitical risk. The Strait of Hormuz situation has pushed oil above $100 a barrel. Energy costs are feeding straight into inflation, and the Treasury is modeling a scenario where oil hits at $200 and inflation peaks at 7%. But tail risk did not exist in 2023. Number 3, budget. Negative gearing on established property is quarantined from 2027. The CGT discount has been replaced with indexation. The trust minimum tax from 2028. These are structural changes to the investor landscape that did not exist in the last cycle. They'll change behavior, 100%. They'll change the buyer pool composition. So no, the risks are real. They are here. The rate environment is harder. The geopolitical backdrop is a lot more volatile. Tax settings are shifting underneath investors. But the core pattern is the same. Sentiment has collapsed well beyond what the fundamentals justify. Supply is still critically short. Rental demand is still strong. Population growth still is vastly exceeding dwelling completions. And the investors who have a conviction to act during the peak will certainly look back at this period, one of the best entry points of the decade. Question is not whether the pattern is repeating. It is whether you have a discipline, guts, the courage to act on it when everything around you is telling you to simply not. Let me show you what this looked like last time with 2 real scenarios. Numbers change, numbers real. Both clients came to us in August of 2023. Same borrowing capacity, about 720 each. Same goals, same fear. One acted, one waited. 6 months later, the gap between them was 141,000. So, client A came to us in peak fear. The headlines were at their worst. Their friends told them they were crazy to be investing in property. Their parents told them to wait. Their broker told them it was tight, but doable. They were nervous, genuinely nervous. They trusted the process. We identified a property in Melbourne's Bayside corridor. It was a flat, declining market. 4-bedroom, 2-bath on 500 square meters. The vendor was motivated. They needed to sell. Presentation was tired. Original kitchen, dated bathroom, average landscape, overgrown grass. But the bones of a home were good, and the street was a strong owner-occupier-led street. It was good school catchment, really low vacancy, were purchased for $585,000. The comparable stock at the time was selling in upwards of $620 to $640, when this one wasn't presented well and nobody was competing because the sentiment in Melbourne was simply down the gutter. They spent $52,000 on a strategic renovation. Think of paint, bathroom, kitchen, flooring, and a tidy up and spruce up of the garden. Not a luxury repositioning. It was designed to shift property from an invested rate to an owner-occupier appeal. Post-renovation valuation came back at $715,000 in a downturn market. And that was for them $78,000 in manufactured equity above their total cost base. The rent was uplifted from $420 a week to $510. The yield improved, the cash flow position strengthened. And today, May 2026, that property would transact in the high 800s to low 900s, even in a softening market. Because a renovation repositioned it into a family buyer segment that holds value on lifestyle and simply not spreadsheets. Now let's shift to client B. Client B inquired at exactly the same time. Similar borrowing capacity, similar goals, but they allowed fear to bring the pause. They waited. They wanted to see what the rates did. They wanted more certainty. They said they'd come back in 6 months when things settled down. And 6 months later, in early 2024, rates hadn't simply come down yet, but prices had already started recovering. The same type of property they were looking at in August of 2023 for 585 to 600 was now trending in the upwards of your 650 to 660. The vendor motivation that existed in 2023 had simply disappeared. The competition was returning. The window had closed. And client B, we eventually purchased with them in mid-2024. They paid $648,000 for a comparable property, which had no renovation upside because the market had tightened and the well-priced cosmetically tied stock had already been absorbed by buyers who moved earlier. They paid more for a similar asset with less upside and less negotiation leverage. Client A is sitting on $78,000 in manufactured equity with a stronger yield position. Client B paid $63,000 more for a comparable asset with no manufactured equity and a weaker yield. That's 141,000 gap in a relative positioning from one timing decision, driven entirely not by data, but simply by emotional sentiment. And that's where the part that stays with me. Client B did not wait because the fundamentals told him to wait. The fundamentals were exactly the same for both clients. Supply was short, demand was strong, vacancy was low, the suburb was sound. Client B waited because their headlines told him to wait. Fear told him to wait. And that fear cost them $141,000 in a relative positioning. Okay, so if you have 700K to $1 million of borrowing capacity right now, the next 90 days are about positioning. It's not about panic. You're not racing to buy something before July 2027, but you're absolutely not sitting on the sidelines pretending that waiting is a strategy. Here's exactly what I'd be doing in your position. Between the next 2 weeks, get your finances revisited and locked in. Speak to your broker now, not when you find your property. Get your pre-approval confirmed at current rates, but also at current lending policy. Understand your actual borrowing capacity after the recent rate hikes and the negative gearing impact. Know your numbers before you enter the market, because the right opportunity appears and the best deals in a low sentiment market that we're moving into. Do not wait for you to get organized. The same 2 weeks, speak to your accountant. Understand how the budget reforms affect your structure. If you're buying through a trust, understand the 30% minimum distribution tax coming through. If you're buying personally, understand the negative gearing quarantine on established property from July of 2027. Get clear on your structure before you buy, not after. The following weeks 3 to 8, the target, the focus where you search on one specific type of the asset: established home, owner-occupied dominant suburb, tight inventory, low vacancy, properties that the average buyer walks past because of cosmetic issues, tired kitchens, original bathrooms, average presentation. Properties where the bones are good, the street is good, the school catchment is good, local demand is there, but the condition is suppressing the price. These are the properties where you manufacture equity. A 50K to 70K renovation that repositions the asset from invested rate to owner-occupier appeal and the rental demand pool can create 60K to 120K plus in equity above your cost base. That manufactured equity exists independently of what the market does, what rates do, and what the government does. You created it. Nobody can take that away from your asset. And right now, where are we looking at? Melbourne stands out. ANZ economists calculate Melbourne is approximately 13% undervalued against its historical price ratio with Sydney. The medium house gap between the two cities is over 600K. The widest in 2 decades. Over 24,000 rental properties were withdrawn from Victoria after the 2024 land tax changes. What this means, it's tightened supply significantly. And let's face it, Metro Tunnel finally opened in Feb of 2026, changing that connectivity across the west and southeast. KPMG is forecasting 6.6% house growth and 7.1% unit growth for Melbourne in 2026, the strongest projection nationally. And population growth into Melbourne is running at over 73,000 per year against a structurally undersupplied market. Now, whereabouts in Melbourne? The western and northern corridors in particular where the maths work at that 550K to 750K price point. Suburbs with high owner-occupier ratios above 65%, tight vacancy rates, rising household incomes, stock old enough to renovate. That is the key here. And also located well enough to have a genuine lifestyle appeal. Now, for cash flow target, a gross yield of above 3.5% at purchase with a clear pathway to above 4% post-renovation. That narrows the cash flow gap and reduces your reliance on tax offset, which matters significantly more right now given the budget changes. And now, the do not do list. This is just as important. Please do not buy a brand new house and land package in the outer growth corridor purely because of a negative gearing treatment is retained on new builds. If the fundamentals aren't there, The tax benefit does not save you. Oversupplied estates with no infrastructure, no amenity, no employment base, and no owner-occupier appeal is still bad investments regardless of the tax treatment that gets put in your pocket. Do not buy an apartment in an oversupplied market for yield alone. Units in high supply corridors with concentrated investor ownership have weaker capital growth profiles and limited renovation upside. The yield might look attractive on a spreadsheet, but the long-term wealth creation is in land, not strata fees. Number 3, do not over-capitalize on renovation. This is not about building your dream home or Pinterest board or an Instagram-worthy renovation. It's about strategic repositioning of kitchen, bathroom, paint, flooring, landscape, not structural extensions, not luxury fit-outs. Every dollar spent must create more than $1 of value. Number 4, do not wait for the all-clear signal. I cannot say this clearly enough. By the time the media tells you to buy and it's safe to buy, the prices would have already moved forward. The window is not when it feels safe. The window is now when it feels uncertain, when the competition is a little bit lower, when vendors are motivated, and when the properties that most buyers walk past are sitting there waiting for someone with a conviction and a plan to see what they could become in the near future. That is my investing approach. We do not wait and hope for growth. We create and accelerate equity through strategy, design intelligence, and simply execution. And let's face it, in an environment like this one, that is just not an advantage. It is the new entire game. If you want help applying this to your current situation, the link to book a strategy session is in the description. And of course, I'll see you in the next one.